Derivatives and risk management. First of all, derivatives. A derivative is a contract between two parties which derives its value or price from an underlying asset. The most common types of derivatives are futures, options, forward contracts, swaps, etc. And the common underlying assets are stocks, commodities, bonds, interest rates, currencies, etc. Today we will discuss basically the options, and later on in different videos I will discuss in detail the risk management also, how derivatives are used to manage risk. That will be discussed in a different video. Now first, options. What is options? An option is a contract that gives the holder a right but without obligation. That is the beauty of this type of contract. You cannot utilize the contract also. That is up to you. The contracts basically for buy or sell of assets including shares at an agreed price. Agreed price means predefined or pre-decided price or before a specified date. Now options are two types: call options and put options. Call options are the agreement to buy asset or shares, that is for buying, and put options are for the sale of shares or asset. That means call option is for buying and put option or agreement or contract is for selling the asset. Now few important terms. Exercise price or a strike price. What is this? So exercise price is the price at which option can be exercised. It is also called as strike price. Underlying asset. I have already mentioned different underlying assets: commodities, stocks, currencies. As a definition, the asset on which the put or call option is created is referred to as the underlying asset. Now option again are two types: European option and American option. What is European option? When an option is allowed to be exercised only on the maturity date, not any date before maturity date. It is called a European option. But American option, when the option can be exercised any time before the maturity date. But in India, most of the cases the option is European option. Next, different possibilities. Possibilities means the possibilities from the side of the investor: profit, loss, gain, like that. Different possibilities. For that purpose, different terms are used to define the possibilities. First, in the money, out of the money, at the money. These are the terms which are used for derivatives. Now, what is in the money? A put or call option is said to be in the money when it is advantageous for the investor to exercise it I have already mentioned the investor has the option to exercise it, not to exercise it. That is the option to the investor. But for the case of in the money, it is advantageous, means benefit for the investor to exercise or apply it. In the case of in the money, for call options, because there are two type of options, for call options, the exercise price is less than the current value of the underlying asset, say shares, like that. How it is advantageous? Because if the market price is higher than the exercise price, then the call option owner will apply it to get the share at the exercise price, which is low. That means the investor will be in the beneficial position, will get the benefit. While in the case of in the money for put option, because it is for the purpose of sale, the exercise money is always higher than the current value of the underlying asset. Because in that case, the exercise price is higher than the current price, for which the put option owner will not sell. The exercise price is higher than the current value of the underlying asset, and in that case the seller will be benefited. Now out of the money, a put or call option is out of the money if it is not advantageous for the investor to exercise it. So what will be the situations? In the case of the out of the money call options, the exercise price is higher than the current value of the underlying asset. In that case, the call option owner will not apply it, because they will purchase the shares from the market itself at a lower price. The market price is less than the exercise price. That's why it is out of the money. Out of the money means not in advantageous position. While in the case of out of the money in the put options, the exercise price is lower than the current value of the underlying asset. As the market price is higher, it is better to sell at the market price. Why you will go for the exercise price as it is low? That means it is out of the money, that is not advantageous situation for the put option holder. Now at the money. What is this at the money? When the holder of a put or call option does not lose or gain anything, that means no loss, no profit situation. When it will be? When the market price of the asset and the exercise price is equal, then it is at the money. It is a situation of the at the money. You can say it is at the money. So these are the different three possibilities. Now, for better understanding, we can discuss through graph. For discussion, we are taking call options. You should exercise call option when the market price, share price greater than exercise price on the date of expiration, at the date of expiration. And when it is does not exercise, when the price of the share in the market or asset in the market less than the exercise price, then the call option owner will not use it or exercise it. That is, when the market price less than is equal to exercise price. In that case, call option will not be exercised by the call option owner. And mathematically you can write this way: value of the call option at expiration. At expiration means what? On the date of application of the contract or option. The value will be maximum of this or 0. This cannot be negative. Why cannot be negative? Because if the share price is less than exercise price, then call option buyer will not apply the call option. That's why in that case the call option value will be 0. But if the share price in the market is higher than the exercise price, then the difference is the benefit for application of the call option. That's why it is written by formula in this way: maximum of this. Suppose if the share price in the market is 120 and the exercise price is 100, then what will be the value of the call option? 120 minus 100, that is 20. 20 and 0, which is the maximum? 20. The value will be 20, because the call option owner will exercise the call option as the market price is higher than the exercise price. It is again written in the mathematical form in this way. Here it is shown by graph. This is the exercise price. I have already discussed at the money. If the x-axis, this is the share price, 0, then it is increasing in this way. At the exercise price, at the money is at this point, exercise price and market price of the share is same. That is break-even point, you can say. We are not considering the premium at this moment, only the exercise price and market price, and that's why it is at the money. In the case of call option, if the market price of the share is less than the exercise price, market price is less, this side, from 0 to this point, then it will be out of the money. That is against advantage of the call option owner, which is represented by out of the money. At the moment the share price goes above at the money or exercise price, the call option owner will use it or will get benefit or will be at the advantageous position. That's why above at the money, whatever the prices in the market of the share, this is shown by arrow, this is in the money. This is graphical presentation for the application of call option. This is out of the money, this is in the money, this is at the money. Now, what will be the payoff of a call option writer? Call option writer means who is selling the call option, not the investor. This is the seller. That will be the reverse picture, whatever I have discussed just now. If this is the no loss no profit point, that is the exercise price. If the sale price is below than the exercise price, then the call option writer will be benefited, because as the price is below than the exercise price, then the call option owner will never utilize it. That's why it is the benefit or beneficial position of the call option writer. But who will be the loser? Call option buyer. How much you will be loser? He is not utilizing the call option, but He has to pay the premium, though I have not discussed the premium, the payment amount for purchasing the call option. That will be the loss amount to the buyer of the call option owner. Whatever the loss of the call option owner is the benefit of the call option writer or seller. That's why it is in the money up to this for the call option writer, you can say, or seller. And this is reversed. You can see the previous graph. At the moment the price of the share or stock or asset in the market rises above the exercise price, that will be the advantage for the call option buyer. And whatever the advantage of the call option buyer is the loss for the call option seller. That is a disadvantage for the call option writer. At the moment the price of the asset goes above the exercise price. That's why by arrow it is shown here, this is out of the money. Value of the share or underlying asset is shown by this line. So this is the graphical presentation for payoff of a call option writer. You can say this is the reverse of the call option buyer. Buyer means who purchase, writer means the seller. Now a numerical example is given to have more clear idea. This is a problem. Say exercise price of ABC Limited is rupees 15 and the call option premium per share is rupees 5. Calculate the value of a call option. If the market price of the share at the expiration date market price per share is 21 and also another case rupees 13 respectively. For both this situation you have to find out the value of the call option. Assume that one call option contains 1000 shares. It is given. Now solution. Solve it. First, gross profit per call option. How much? Per share. It is the exercise price and it is the market price. That's why the difference is the benefit gain. Call option holder will exercise it as the market price is more. Per share 6 rupees will be the gain or benefit because the call option owner or buyer will get the share at the price rupees 15. So the market price is 21. The difference is the benefit per share. And what is the gross profit? And one call option contains 1000 shares. That's why this is the gross profit, you can say. Why it is gross profit? Because out of this you have to subtract the cost to acquire the call option document or agreement. To per share you have to pay rupees 5 as premium. Whatever the cost, it is called premium. You know how much cost is required for getting the call option? Per unit share is rupees 5 and 1000 shares for one call option is rupees 5000. And this is the gross profit and this is the cost. That's why 1000 is the net profit. If the market price of the share is rupees 21. Now see this case. When the market price of the share is 13 and exercise price is 15. I have already discussed, in that case the call option owner will not exercise it because he will purchase the share from the market. He need not to apply the call option. Then what will be the gross profit from call option? Per share, this is negative, that's why you will not apply it. That's why 0, the gross profit from the call option will be 0. And how much cost required to acquire it? That is 5000. I have already mentioned above. Cost for premium per unit share is rupees 5 for 1000 shares in a call option. The total cost will be 5,000. That's the total loss will be 5,000. That's why it is written in bracket. It means negative profit or loss. In this way, you can find out the benefit or loss or application of call option. To discuss in more elaborate way, another problem has been discussed here, and graph is also to be required to show for the results. Then what is the problem? These shares of ABC company is selling at rupees 104 at present. Mr. Ram buys 3 months call option. 3 months call option is means expiring date is 3 months. After 3 months it will be applied at a premium of rupees 5. The exercise price is 105. I have already discussed what is exercise price. This is contract price or agreed value price. What will be Mr. Ram's payoff if the share price is rupees 100, 105, 110, then the different situations for the market price of this share, 120. At the time the option is exercised. Also show the relevant graph. Now see, if the price is 100 and exercise price is 105, so Mr. Ram will not apply the option, call option. That's why gross payoff is nil, but he has to invest rupees 5 as premium to purchase the call option. That's why in this case the net payoff or loss per share will be rupees 5. If the sale price is 105, exercise price is also 105, again it is nil payoff because there is no surplus and premium is 5, that's why loss again is 5. If the price is 110, exercise price 5 and the benefit is 5, that is gross payoff, premium is 5, that's why net payoff is 0. In this way. And last one, if the price, sale price is 120 in the market, this is the exercise price, how much benefit we get by the call option owner per share rupees 15, because this is higher than this, the call option owner will get the share at this price and the difference is the profit, and cost as a premium rupees 5 per share, that's why the net payoff or loss or profit is 10. You can present the result through graph also in this way. See, this is the distance, this distance is rupees 5. The x-axis, this is the share price. This represents the share price in the market. So this is 100, 105, 110, 15 in this way. And this is initially 0 position. If the share price is 100, that I have already shown in the table, the loss will be rupees 5. That's why loss minus 5. Even if the strike price or exercise price, same thing. So here it is written strike price, or you can say it is exercise price, all the same thing. Rupees 105. Then again it is no loss. Again you will be no loss. Sorry, you will be in loss of rupees 5 because you will not utilize it. A premium payment is your loss rupees 5. You can check from the table. When the sale price is 105, the loss is 5. Next, if the sale price of the share in the market is 110, then you will be, Mr. Ram will be in no loss, no profit. Mr. Ram will be in no loss, no profit, 0 profit. Because here it is gain or profit, and here it is loss. In this x-axis means 0 profit. Because the exercise 5 is, price is 105, sale price 110, the difference 5 is the gain, and from that you have to pay the premium rupees 5, no excess amount, that's why no loss, no profit, or 0 profit. Now in this case, when the sale price is 115, then will mean profit of rupees 5. This is rupees 5 profit because 105 is the exercise price, rupees 10 is the gross profit, and from that you have to subtract the premium cost rupees 5. Ultimately you will get 10 rupees of profit. In this case rupees 5, because the sale price is 115, exercise price is 105, then gross profit is rupees 10 minus premium cost rupees 5, the net profit is rupees 5. That means this is vertically, this is 5, this is 5. And for this case, in this way you can see the sale price is 120 minus 105, gross profit is 15 minus premium rupees 5, that means rupees 10 is the net profit. This is net profit. Again, if the share price increases, the profit will increase. That's why the line is increasing. So this is break-even point, no loss, no profit point. This is exercise price, and this is in the money. I have already discussed what is in the money. This is the advantage, benefits area, benefits position of the call option buyer, and this is out of the money because no benefit in favor of the call option buyer. That's why it is out of the money. And this is premium amount, share price, everything is presented in this graph. I think now it is clear. All these terms, strike money, strike price, exercise price is same thing. I have already discussed. In the money, out of the money, call option, put option, everything I have discussed. You do yourself the case of put option similarly, same. Now here is a message. If you face any problem or queries, you can put in the comment box. You can also give suggestions. You can also put your suggestion which topic or you will be interested. I will discuss it in next video and later on my videos. If you face any problem, you mention it. Definitely I will reply at the earliest possible. Even if you like to discuss, you can write to this mail, and my preferred time for discussion is this. I will inform you accordingly. Thank you very much, and just wait for the next video. In my next video I will discuss the valuation, how you will value the option, binomial option pricing model, single step, double step, risk neutral method. All these things I will discuss in my next video. Thank you.